Well, Billy Joel told us to appreciate life through his lyrics. These are the times to remember, because it will not last forever. Our next guest says those lyrics also apply to the recent run-up in the stock market. I'm not sure we're viewing it through the same sort of filter of nostalgia and joy, however. Joining us now, Michael O'Rourke, JonesTrading chief market strategist, who quoted those lyrics in a recent note. Mike, when we look at what's going on in these markets, I mean, you've been doing this for a long time. I've been doing this for a long time. What stands out to you as particularly unique, unusual, and maybe cause for good and bad signals right now?
Well, obviously, there's a lot of parallels between the internet bubble and AI. Obviously, there are groundbreaking technologies that are going to change the way the world works. There's no doubt about that. But of course, foundational in creating a bubble is something that's a widely held belief that is factually believed to be a correct and bullish and optimistic. So that fuels it. As far as the note the other night when I talked about that, it's when you start seeing things that are really out of the ordinary or atypical that you'd really be surprised to hear people say or do. It's when I think you should really be concerned. So the example I used from 2000, there was someone talked about Cisco, whose market cap at the time was about $300 billion, was going to be the first $1 trillion company. And that was definitely a very serious conversation being had at the time. And then InfoSpace, which was a smaller company, the CEO said they're going to be a $1 trillion company. Things like that were so far. I mean, the largest market cap at the time was probably $480 billion. So then you see episodes like today, whether it's OpenAI talking about getting the government to backstop, federally backstop chip investments, whether it's Elon Musk getting a $1 trillion pay package. Things like that are very atypical and you wouldn't expect to hear in a conventional investing environment.
But as you say, like in context, they make sense, right? There is an argument to be made that these things do make sense. And I have to say, Mike, most of the people we're talking to are saying, it's not really a bubble. It feels a little bubbly, but it is not a bubble because unlike in the .com era, these companies make money, et cetera. What would you say about that?
In the .com era, a lot of companies made money as well.
Right.
And coming out of the .com era, Amazon has been by far the most successful company. That still did not, stop its stock from declining more than 90% after the bubble busted. So, and then you can talk about the Intels, the Ciscos, the Microsofts, not the Pets.coms of the world. Those companies all had their shares decline, 60 to 90%.
So Mike, what's the Pets.com? What's the InfoSpace? What are those companies now?
Oh, there's so many small, whether you want to call them AI companies that rally on news and headlines, with whether they're citing AI, whether they're citing partnerships. But the thing is, we won't know them until they bust. I guess the point I'm trying to make, even the highest quality names that have great fundamental businesses are still going to be at risk to any type of bubble busting. And I think one of the things that people failed to realize back in 2000, companies were still reporting earnings growth and revenue growth into the end of the year. It wasn't all of a sudden the business stopped. And that, there was a lot, they saw fundamental strength because their customers were double ordering equipment and things like that. And, we see similar things today where you have companies announcing, it's actually even more extreme because you have whether these, $100 billion orders going into, whether it's NVIDIA, the hyperscalers, from companies that don't have that big a history or that much revenue. So there are questions about the environment we're in where you can't look at these, the Mag 7 names and their backlogs and sit there and say you have 100% confidence that that backlog is going to come through and those bills are going to be paid down the line.
So, Mike, when we saw the .com bubble burst, we were in a Federal Reserve tightening environment. Now we're in a loosening environment. I'm curious what you think the sort of candidates are for a catalyst, if this is a bubble, for it to burst.
It actually, all it takes is a deceleration of the headlines, the stories, the growth. I mean, for example, you have Taiwan Semi reported its October sales last night, and they're up 16.9% year over year. Now, granted, it's on much larger numbers, and of course, Nvidia over the weekend talked about ordering more chips. But you're going to see these growth rates decelerate, and again, after having well over $1 trillion in deals announced in the past few months. And again, this is kind of a one-time build out or the initial build out for these structures, right? At that point, what are the growth rates going to be going forward? You're going to see those decelerate. And again, if you recall back to 2000, there wasn't a headline or a story that, the market peaked on. It, ran out of momentum. And I guess that's the risk here is you see these growth rates slow down. You see these headlines about hundreds of billion dollars of deals slow down, and then people will start questioning the momentum behind the trades.
So as you know, Mike, it's tough to time the market of when that could happen, right? But are you taking steps now or recommending the folks take steps now to try to insulate against that? And what do you do?
So with a bubble, it's hard to know when a bubble is going to pop or when it's going to peak. Now, again, I'm in the camp where I'm convinced we're in a bubble. What I do know is when you buy during that bubble and you build positions during that bubble, those usually turn out to be losers. So again, maybe you're not selling what you have, the names you have now, and maybe you're not liquidating your portfolio. But I'd be very cautious in adding to positions at bad price, what I would perceive to be bad prices. And I think that's the best way. You could protect yourself. And even though, you said we're in a Fed easing environment, but that remains in question as to whether the Fed's going to lower rates next month. And also, you're talking about, the 10-year yield is at 4%. That's a pretty healthy, yield for Treasury bonds for, risk-free income. So I think there's places to be more defensive. And then again, I'd wait till valuations become more attractive and let some of this storyline subside. We've had a phenomenal 43% rally off the April lows. We're heading into year end. I mean, it's a great time for investors to say, hey, it's been a great year, and I'm going to move to the sidelines for a little while.
Mike, bringing some fire today. Great to see you. Thanks so much for being
Likewise.
with us. Thanks.